Coming of the new year tends to be a time of reflection, and it seems to be the bread and butter of the mainstream media, who look back at the year just gone and perform an autopsy on things that worked and things that did not. And this particular piece from Business Insider caught my eye, and it looks at how short sellers in the US market fared last year. And as you can see from the title, it says investors lost $195 billion shorting stocks in 2023. Here were the 10 most painful bets. And the article then goes on to look at the various stocks that individuals and institutions shorted, those that worked and those that did not. But for those who are unfamiliar with short selling, here's a quick little primer. It's an extremely simple concept. It is literally the reciprocal of buying and selling. This is an example using Star Entertainment, a local stock, which I think has the honour of almost being the dog of the year for last year. The idea in short selling is that you sell the stock at a given price and you buy it back at a lower price. Your profit is the differential between those 2 points. The overwhelming requirement is the price must be going down. That's it. Latch on to that point because I will come back to that as a very salient point at the end. Short selling actually provides a very important service for the market. It is much maligned, and it is often maligned by company owners when their share prices begin to collapse. They say it's the fault of evil short sellers. No, it's more than likely the fault of crap management being exposed. Short sellers are very good at providing price discovery. Their mere presence in the market adds liquidity. The more liquidity you have in the market, the better the price discovery is. And short selling adds to this considerably. And in falling markets, contrary to what regulators think, short selling dampens volatility because of its provision of liquidity. This misconception among regulators does cause problems, particularly here in Australia, because when you get a widespread market panic where short selling would be very valuable in providing liquidity and dampening volatility, they have the reflexive action of banning short selling. All this merely indicates to me is that regulators are stupid. So we can take that as a given. So short selling is a valuable tool. It's a valuable tool for markets, and it is a tool for traders and investors in its place. But the caveat is the notion of in its place. It has its place and its time. And as we'll see, that is the most important criteria. You short sell when its time has come and you understand its limitations. And the limitation of short selling is simply the returns you'll generate from it. Theoretically, and I do say theoretically because it's not quite correct, stock prices on the upside are unbounded. You could buy a stock like Chalice Mining at 30 cents and sell it at $9. Your gain is extraordinary. Short sellers are often caught in the false view that what will happen is they will sell a share at $1 and buy it back at 1 cent. That won't happen, because long before it gets to 1 cent, it will be taken off the short seller list and your position will have to be closed out. So there are practical limitations. But let's return to this piece. As I said, this piece generated a retrospective look at a series of trades that were undertaken. And I've taken the data from that and broken it down into 2 tables. The first looks at the losses incurred by short sellers, and I've actually added a column to this. And you can see here are the worst 10. And so we've got 3 columns. Reading from left to right, we have the stock itself, the losses incurred by short sellers, and the final column on the right is the price performance of the underlying stock. So if you read the first line, we have Tesla, in which short sellers lost an aggregate of $12.2 billion US. But during the year of 2023, the calendar year, Tesla went up 102%. And here's the key point when you look at this particular table. If we look at the losses incurred and then look at the price performance, we see a startling relationship. And the relationship is that all of these stocks had a stellar year. The worst performer is Apple with a gain of 43%. The best performer is Coinbase with a gain of 343%. So if we were to flip this notion on its head, if short sellers, instead of shorting the stock, had actually bought it, they'd have the reciprocal performance. That's a bit dodgy, but it works as an idea. If we then look at the second group of data that this article provided, I've done the same thing. So it's same three columns, but different headers. These are these short selling positions where short sellers made gains. And this is the price performance of the stock for that year in terms of how much it lost. And you can see that the color coding is reversed. In this, if we take the first line, we've got a gain of 1.6 billion and a staggering price loss of 99%. You see something interesting. If we compare it to our first table, our short sellers are misaligned with price performance. These peanuts have been shorting stocks that are going up. I'm not an expert, but I don't think that's going to work. On the contrary, these people have been short selling stocks that are going down. This is this alignment between strategy and price performance. You have a match between the two. And I've just re-edited our initial table, and you'll see that I've highlighted some of the stocks in yellow. I've highlighted those because these particular stocks are what is known as the Magnificent Seven. It was these 7 stocks that generated the bulk of the US market's performance last year. So let's put this in context. These short sellers, many of whom manage money for other people, decided that it would be a really, really good idea to short sell stocks that were driving the market up and that were the main price drivers for the market. They were not accessory to the market's performance. They were the market's performance. And I just had a little bit of a dig. And when they were short selling, these are the sorts of headlines that they would have seen. All of them talking about the staggering performance of these stocks. And if we look at the broader US market where these stocks all live, you can see that for 2023, for the broad S&P 500, it was a very good year. We can see the market begins with a small pop, then a drift down, then a longer recovery taking us through to the midpoint of the year. Market drifts off, then recovers strongly towards the end of the year. But those particular stocks, their home is the NASDAQ. And if you look at the bottom part of this chart, the bottom part of this chart shows you the value of $10,000 invested in the NASDAQ 100 at the beginning of the year and its terminal value at the end of the year. If you put $10,000 in the NASDAQ, at the end of the year it would have been worth $15,381. This is a staggering performance. For an index, this is quite remarkable. And that performance was driven, as was the S&P 500, by these Magnificent Seven. So this brings us to our second rule. When you are short selling, the market must be going down. If I look at this chart of the NASDAQ 100 from any angle, it is not going down. So we have this strange cascading of contrary opinion, where for some reason, and I'll come to reasons in a moment, investors and traders thought that what they would do is they would short the strongest stocks in the market during the market's strongest period. You can see the idiocy of that immediately. And also bear in mind, many of the people who did this are fund managers who are paid sums of money that would make your eyes water. And if we just take a quick look at one of these stocks, Nvidia. Nvidia was one of the darlings of the market last year. All the money in Nvidia was made on the long side, not the short side, and we can see why. Because the stock began the year at 120 and finished it at around the 500 mark. So that's an extraordinary gain. Most of the gain was made in, let's say, the first 2/3 of the year. Price then consolidated. And the consolidation range is quite small. So I understand that people do trade different time frames, and this is a daily chart. And undoubtedly there would have been people in there looking at 1 minute charts and desperately trying to short sell this. But again, I consider that to be a mug's game. All of trading is about, as much as possible, aligning all factors in your favour and not fighting those factors. So this raises the question as to why do people do this? And there's a few reasons. It's obvious to say that markets work on variant perception. That is, people have different ideas. If everybody had the same idea, then markets wouldn't work. But there is a secondary aspect to this, and the secondary aspect to this is when you put a trade on, think about alternative points of view. What happens if you are wrong? So if we think back to the size of those losses that were suffered collectively, they're in the billions of dollars. People would have suffered staggering losses short selling these instruments simply because they could not entertain another point of view. But this does beg the question of what was their point of view? What were they thinking? Well, for many, it would have been as simple as, it's gone up a lot. Well, yes. And my second somewhat intellectual point would be, so what? There is no law in markets that says that once a stock or any instrument has gone up a given percentage, it must stop and it must come down. And this is seen in some of the extraordinary gains that, in particular, smaller speculative stocks like the Australian miners make. These stocks don't just make gains of 1 order of magnitude or 2 orders of magnitude, they often make gains of 3 orders of magnitude. There is no speed cop for share prices that say, look, you've gone up enough, you have to stop, give somebody else a go. And that, if I were to assign a percentage to the rationale for why people do things like this, it would simply be, it's gone up a lot. And the reciprocal of this is that when stocks are falling, the reverse opinion holds true, where people say to themselves, it's gone down a lot. Now, there is actually a traffic cop for prices falling. It's called zero, so they can't go below that. But you can see how intriguing this point of view is, because it's tied up in an internal notion of value. You think you know how far something should go. You think you know how much something should be worth. Here's a news flash. You've got no idea. But people come to this perspective of it's gone up a lot or it's gone down a lot simply by gut feeling. And what happens then is they reverse craft a narrative to fit that, so that they build a model that fits their feeling, not the other way around, where the data is accumulated and you build a model for the data. These people have an idea and they look for whatever confirmation they can generate, hence the term confirmation bias. The final reason, and this will seem harsh, but it's this. People are stupid. They do stupid things. We do stupid things all the time. Sometimes the consequences are minor, sometimes the consequences are major, but they are all underpinned by stupidity. There is an assumption that everybody involved in markets is, let's use a loose term, a rocket scientist, highly educated, highly intelligent professional operating according to a prime set of rules, a prime directive that drives their behaviour forward, so that when they make a decision, it's done according to a matrix of factors. Risk management is then enacted, trade is taken. That's not so. My experience of things, even in money management, is that many things are governed by, I reckon, I'll have a crack at, I think. They're not really logical frameworks to work by. So bear this in mind, but bear in mind for yourself, you too can be stupid, as am I. And you have to be constantly on your guard as a trader that your emotions don't drive you towards stupidity. So if you are going to short sell, and as I said, it is a valuable but sometimes limited tool, there's really only two prime rules you need. And as we've seen, if the people involved in this particular article had followed these, they would not have taken a savage reaming. The market must be going down, and I don't mean it's gone down for 5 minutes, therefore. I mean it is trending down over the long term. It has broken down. Remember the phrase, it has broken down. And the stock must be going down. You must have that alignment between the two. But it's also important to remember that the market is always right.